Welcome to Rebank, your front row seat to the future of finance. Niklas Kunkel, welcome to Rebank.
Thanks for having me, Will.
It's great to connect with you. I've enjoyed all of the interactions that we've had over time, and I'm very happy to dig into to Chronicle and everything you guys are building.
Yeah, I think we've run into each other in a few places now. It started with you kind of bringing me into your world of stablecoins, and I'm glad we can have this conversation today, kind of giving you a peek into my world of oracles and tokenized assets.
Listen, to dive right in, maybe we can frame this with some of your past experience. So you were early at MakerDAO, and I think played an instrumental role in building what was the DAI stablecoin, now USDS, and then ultimately recognizing a lot of the maybe technical requirements or non-intuitive infrastructure needs that were needed in order to stand that up and make it scale the way it has. So just to frame our conversation, I wonder if you want to share any of that background.
Absolutely. MakerDAO was quite a pioneer in the space in that they not only predated DeFi, but were building a product, in this case, decentralized stablecoin, for what they perceived to be a world where DeFi was already inevitable. And I think that was quite prescient. Looking back, it kind of became a self-fulfilling prophecy. But I can tell you at the time, I even had a few questions around what are we really building here, given that Tether already existed at the time.
Maybe to kind of jump off from there, can you tell us maybe more specifically what you were focused on in kind of the initial build out of DAI, and then specifically what the Oracle needs, data needs, which have framed, I think, your perspective around where work needs to be done in the space?
Absolutely. So when we got started, there was nothing. Anything you needed, you had to kind of go have a think and build yourself. So there was really a period of about a year where we weren't even building DAI, the stablecoin. We were building all of the underlying infrastructure that you would need to build a stablecoin. One of those things that I led the development of was the first oracles on Ethereum. There was no Chainlink at the time, and we needed a way to price the loans and kind of solvency of the stablecoin. I think very few people know this, but MakerDAO made the first decentralized exchange on Ethereum. I think a lot of people believe it's Ether Delta. It was not. Ether Delta was predated by at least like 12 months by something called Simple Market, which was a solution for funding ourselves, given that there were almost no venture capital firms in the space willing to fund quote unquote projects, right? Not companies, but projects, right? Run by couple of kids, straight out of school with not much, technical nor financial experience. So definitely prehistoric type of building phase, but one that ultimately I think proved quite prescient.
Mm-hmm. So to double click on Oracle specifically and data. So firstly, let me just set this up for the audiences, and specifically those that aren't DeFi native. So the concept, and please jump in and correct me anywhere, but of DAI, now USDS, is basically that a user can come in and deposit a certain type of eligible collateral and basically receive this asset newly created, which was pegged to $1 and therefore could be used in DeFi as if it were $1. And so specifically the data and Oracle references are to the value at any given time of that collateral that the user came in and contributed, because there was a value at the point of initial contribution. So you need to know how many of these newly issued stablecoins could be received back by the user in exchange for a set amount of collateral. But then also, I think the way that DAI is structured is that there's a sort of LTV against the ongoing value of that collateral over time. So because I think at the beginning, maybe it was only ETH that could be posted, Ether as collateral. And then over time, other types of crypto assets and then real world assets, RWAs, have since been included. You basically needed ways to track the value of that collateral position on a dynamic basis, so that effectively those positions could be closed out if and when necessary. Let me tee you up now, Nick. That sounds pretty straightforward, right? I can go on, coin market cap, and I could see the value of these assets. So what's the big deal?
So one, I think your description of functionally the purpose that Oracle serve, extremely eloquent. I don't think I could do much better. I think the problem arises with what are the second order effects if an Oracle misreports a price. Depending on if you are over reporting or under reporting, you can really threaten the solvency of the entire protocol and of the stablecoin. So for example, if an Oracle were to report that Ether is worth $1 billion, then anyone could, put in a fraction of an Ether as collateral and borrow a disproportionate amount of capital, right? And so the system would immediately go insolvent. Looking at the opposite scenario, right? If the Oracle reports that Ether is worth 1 cent, the protocol would start liquidating its entire book. And given that I believe at one point there were almost $15 billion of Ether locked in the protocol, you could imagine what $15 billion worth of Ether being liquidated on chain all at the same time, what kind of effects that might have. So the role of the Oracle is quite simple, but it requires an enormous amount of diligence and security, because this is kind of the main vector that a malicious actor might use to attack a decentralized financial protocol.
Right. That last point is extremely important as well. So on the face of it, it's a price feed. But you're saying that if that price feed is out of line for whatever reason, that there can be massive implications. Because I guess this is different from maybe in like a kind of traditional off-chain world where you're doing some sort of like valuation of assets at any given time, maybe for like financial reporting purposes. This is where the price feed is basically an input into an automated system where an update to that price feed can basically have a sort of instantaneous flow-through effect on the broader system. And then secondly, it's not just a price feed, it's actually one of the most important security considerations, because to the extent that someone does want to impact the system to most likely extract value from it, going via an Oracle would be the best way that they would do that. That makes a lot of sense. I wonder if maybe just to sort of bring this home to people a little bit more, like, are there any lessons that come to mind, from your time building oracles in the space, whether it was at MakerDAO or more recently at Chronicle, lessons learned the hard way that really kind of inform the way you think about this space?
In Ethereum, right, or in any kind of blockchain, you have to pay a transaction fee. It's called gas, and has its own kind of unit of account, which is usually in some 10 to the minus 9 decimal of whatever the native cryptocurrency is of that blockchain. So Ethereum is no exception. For many years, the transaction price of Ethereum was one of this unit called a GUI. And this was so consistent. And these transaction fees were essentially a function of the demand for doing transactions versus the amount of capacity that Ethereum had to handle incoming transactions. We had a hard limit written into our code that the transaction fee could not be more than 10 GUI, because clearly something would have had to go ludicrously wrong. It must be a bug if we ever calculated that a transaction fee should be 10 GUI, because we had not once ever seen it deviate from 1 GUI. We found out very late into 2017 that was a very wrong assumption to make, when all of a sudden all of the oracles froze up when some of these ICOs, initial coin offerings, were seeing 3 orders of magnitude increased demand, right, for inserting your transaction into a single block. So lesson learned, whatever you think is reasonable as a max cap, you should probably, expand that 2 to 3 orders of magnitude. I think something more serious is related to the innovation and growth in DeFi. And as a kind of core infrastructure provider, balancing that with the level of focus, how would I say this? Knowing when to say no. So I think the story of DeFi has always been one of innovation, of launching new financial products. Very frequently, these are in the form of new tokens. And it is quite understandable that the first thing any issuer of a new cryptocurrency or crypto asset wants to do is, how do you get more utility for this token? And the go-to usually is, well, we want people to be able to borrow and lend this token. And so, great, we're going to need an oracle. So they come to Chronicle, right, and they say, like, hey, we need an oracle. And we start looking at this new crypto asset, and it's like, okay, what is the liquidity profile? Where is this traded? How much liquidity is there? And frequently, these venues are so few and so illiquid due to how young these new crypto assets are, that it becomes a huge moral hazard from an oracle provider to decide whether to build an oracle for this customer that objectively is not very strong due to the ability of malicious actors to manipulate primary market sources due to this thin liquidity. So the oracle provider is really in a position of, do you want to get as much growth as you can, or where on that gradient are you forced to push back, right? And I think every oracle provider ends up on a different spot on that gradient. We've seen how that can end in unfortunate circumstances. When you see lending protocols being hacked, in most cases, it is due to a malicious actor manipulating the oracle by using a good sized amount of capital, or in some case even very little is required due to the low liquidity, right? And just moving the market at will and almost painting the tape.
That last point is of just crucial importance. And I wonder how you think about it, because most simplistically, there are kind of maybe two approaches. On the one hand, you basically say, okay, we're going to point an oracle at whatever the on-chain price is, or we're going to configure this oracle based on the on-chain price. And maybe there's some math involved, like it's going to be some sort of time-weighted or volume-weighted average, or you're going to look across a variety of different venues, and those things can kind of like maybe blend some of these price movements. But ultimately, they're not, especially to your point, for a less liquid or lower volume token, they're not foolproof. So you could basically have a bad actor that comes in that does some sort of understands how an oracle is configured, understand what the oracle is powering, and then goes and basically manipulates the market price of the asset on one of these venues, which has a flow through effect into the protocol or application that they're targeting. And could result in, say, the liquidation of a position. And there've definitely been examples of this. I guess on the other side, the sort of extreme end of the spectrum, I don't know, I guess maybe they're kind of two options. One is you can hard code a value. And I think there were even examples of October 10th liquidation events in crypto where Athena assets, for instance, were hard coded in certain protocols. And it, in retrospect, was beneficial because despite pricing swings of those Athena assets, positions weren't liquidated, which in a sense was a good outcome, but question mark as to whether it was the free market outcome. And you could, of course, imagine many risks to hard coding where it doesn't produce a good outcome. And then I guess the sort of other option, not very DeFi native, would be, is there some sort of centralized, almost like human managed input, where maybe more discretion can be implemented. Obviously, all sorts of risks, and it generally breaks a lot of the like atomicity or instantaneity of some of these systems. So I wonder, as you look at that sort of menu of trade-offs, how you personally and probably manifested through your work at Chronicle, think about those various trade-offs.
So this is such a multifaceted problem. And I think if you put several different Oracle providers in a room and ask them to create the perfect Oracle for, let's say, Athena USD, I think you'll get three all slightly different kind of combinations. Top of mind for me is this hard pegging of assets, right? So you mentioned Athena. Um, we only look back on that as a favorable way of configuring something because it worked out, because it led to a good scenario. In the case where Athena had actually failed, it would have essentially imploded all of DeFi because of the cross contamination, right, on the scale of billions of dollars, right? And so I think you don't really remove risk. You just get to kind of like change the shape of it and move it around and optimize for certain scenarios while making other scenarios considerably worse. I think it really can be asset specific. There are some assets that DeFi protocols will adopt in such a high magnitude of concentration that they are essentially already taking existential risk on that underlying asset not failing. And in those cases, you've essentially already accepted the worst case scenario. And so I think it can make sense to just hard peg in that case, right? Because you just want to ensure that you don't have any unprompted unwinds, right? If there's a failure, you're dead, right? You have no ability to cover your position and to try to survive. But if it recovers, you're fine. So I think that's kind of the thought process of many going the hard pegged route. I think the way that we would approach it probably is more of a hybrid approach. So you would start looking at different types of data and different types of action that you see or events that you see in the market. And the Oracle will essentially oscillate between different, you could think of it as data models, right? Different ways of modeling what it sees and then giving an appropriate response. I think one of the critical pieces, which I would implement for an Athena Oracle, is that the Oracle is looking at the underlying reserves, that it has that real-time access at the custodian level of, what are these reserves? Are they actually there? What is the quantity? Let's estimate the current market value. Let's compare those calculations to what they were sampled across different timescales, right? A minute ago, 5, 15, 30, an hour, 24 hours. And now you can build a much more robust way of modeling something where it's not just a misreporting or a fat finger somewhere, right? That could cause this accidental cascade of actions, right? Where you can't go back once you've triggered a liquidation. So it's a very complicated problem. And unfortunately, right, there's not a very elegant solution, right, that fits all boxes. It really comes down to a case by case basis based on like the asset itself, but also like how is that asset being used in DeFi? How is this Oracle being used?
Makes sense. So that example there, where you can basically look not purely or even perhaps not at all at the secondary market price, and you can look specifically at the reserve composition, gets into this distinction between real world assets and crypto native assets. And there's probably a lot of gray area in between. But fundamentally, something that exists only because it's been created by a smart contract and doesn't have any collateralization or off-chain value backing it, and other types of assets, which are or other types of tokens, which do have some sort of off-chain or real-world value, either directly tied to them or collateralizing them. When you were building DAI, it sounds like the focus was, at least initially, purely on crypto native assets. Now at Chronicle, I believe you're specifically positioning toward the real world assets, the tokenized finance space. I wonder if you want to talk a little bit about where your focus is now and why you see that as the most important opportunity.
I think it's really a question of where's the growth. And if you look at DeFi growth, less stablecoins, DeFi growth has been relatively stagnant. And when you look at what are the drivers of DeFi growth, you really have to understand what are the base layers of value that DeFi can kind of build on top of. And that has traditionally only been Ethereum and Bitcoin. So if the market cap of Ethereum or Bitcoin doesn't grow or grows at a muted pace, that is kind of the same pace of growth, right, that DeFi is locked into. And so I think the big unlock was, one, that this is kind of nonsense, right? There is a huge pool of traditional financial assets out there, right, which can serve as high quality collateral and that would benefit from the utility that tokenization and DeFi can provide. And so it was a really easy decision for us to go in this direction, even before really this kind of growth engine kicked in on the tokenized asset side. I think during my days at Maker, we got like a very early sneak preview at this. I can tell you what the driver is from a DeFi perspective. DeFi essentially is very boom bust and is highly correlated in terms of revenue with, are token prices going up or are token prices going down? When token prices are going up, right, there is a high demand for leverage. Borrowing costs are very high. And these DeFi protocols in some cases can print hundreds of millions of dollars of revenue annually. The problem happens when token prices start going down consistently, and all of that revenue evaporates as the demand for leverage in turn evaporates. And so from a DeFi protocol perspective, right, there is a general desire, right, to diversify revenue to non-crypto correlated sources. And so fixed income, traditional financial assets, in particular, money market funds, various forms of private credit, CLOs, became very attractive. I think the early forays into that went rather terrible, as you can imagine. A bunch of people who are technologists and didn't necessarily have the skill set necessary for underwriting private credit, I think leads to a very obvious conclusion. Those early forays, I think almost all of them defaulted. But the amounts of money allocated into those were considerably small, and they were very much learning experiences for Maker and for all of us building kind of the necessary infrastructure, right, to support these types of non-crypto assets into this cryptographic system. And I think one of the things we learned, right, is just how critical oracles are for this type of integration, right? You're taking something that exists in the real world and, some people call it a digital twin, right? Printing this token. And you're saying that the two are tethered in some kind of way. But from a technology perspective, from a protocol perspective, code perspective, it has no way of knowing. And so it again presents this same kind of intractable oracle problem of you need this source of truth to definitively say, is this token actually backed by what it claims to be backed by? What is the value of that? What are kind of second order contextual data which can complement the general pricing information? So for example, how much liquidity is there to liquidate something? With money market funds, right? Generally not that much of a concern. One of the most liquid markets in the world. But when you get into private credit, considerably much more difficult. And so these are all relevant when it comes to extending credit against these types of assets and subsequently, right, monitoring the health of that credit position. And so this is kind of the role that like oracles have really morphed into in terms of starting in DeFi as just, oh, here's the price, and this price is needed to monitor the health of a credit position, to now Oracle saying, here is all of this metadata which is relevant and contextualizes this traditional financial instrument. And all of that data is necessary for DeFi protocols, right, to integrate these financial assets at scale.
Yeah. Yeah. No, I like how you describe oracles. It's easy to refer to them as kind of the connective tissue between off-chain data and on-chain, activity. But really, it's well-built oracles which support the programmability of on-chain finance without effectively, whether it's real time or at least always available data feeds, specifically pricing information. But I think you mentioned some other things like depth of liquidity. It's very difficult, if not impossible, to run fully automated systems. A couple thoughts for you, which I'd love for you to help me unpack. So I totally get the crypto asset use case of basically secondary market pricing and building an oracle around that. When it comes to tokenized assets, there are more variables. There's also a lot of precedent. There are also legal requirements, potentially fiduciary requirements on behalf of asset issuers and asset managers, some of which probably improve the quality of assets and others which may not be so easy to reconcile with DeFi in the way it's been built. But at the highest level, firstly, a lot of tokenized assets are NAV based, at least anything that's structured as a fund, meaning that the value of the portfolio or the assets that back that token is calculated and reported on some sort of regular basis. In the case of money market funds, generally daily, sometimes more often. In the case of other assets, maybe quarterly, maybe even more infrequently. There can be questions around the true sort of like, is the NAV actually the liquidation value of the portfolio assets? I mean, these are questions in traditional finance as well. In a money market fund, yes, because they're short-dated treasuries. In a private credit fund, most likely no, because it's very difficult to understand what the actual market price of any illiquid privately owned asset is at any given moment in time. But nonetheless, there's a NAV. There is also potentially a secondary market price for some of these assets, though I think to your point before, in general, the actual like transactability of these assets is extremely low, and therefore depth of liquidity or even secondary market data points effectively don't exist for most tokenized assets. So that's not really, at least as of today, a viable path. Maybe it'll be a viable path to build oracles around in the future. Given those things, like simplistically, you could say, well, there is a NAV already. There's often a regulated party that's responsible for calculating it and publishing it. Are there use cases in which that's sufficient? Are there questions around the data quality or indeed truth of that data which is flowing through? And then I guess at the highest level, how do you reconcile that traditional kind of financial asset market structure / valuation with the trustless nature of DeFi?
Yeah, $1 million question, right? The first thing you have to understand is oracles are not magic. They are a pipeline, right, of getting data from point A to point B. If the data going into an oracle is garbage, garbage in, garbage out. So in that sense, where you source data from is extremely important. You can imagine getting data from an issuer presents a certain degree of counterparty risk, right, and particular moral hazard. And so really you want to have the closest to origin level data as possible. So in this case, or in most cases, right, that is a custodian where the oracle can look directly in the securities and cash accounts and effectively replicate a lot of what the fund admin is already doing. I think in that sense, fund admins and oracles rather complement each other fairly well. And I think ultimately will end up working together quite closely. I mean, I think it's important not just to look at how finance is structured today and imagine more where you see this merger kind of happening. And so you really don't necessarily want to find your hole, in the crypto system as it is today or in the traditional financial world as it is today and position yourself more towards what does this unified hybrid system look like? Because it's quite clear to me that, and many others, that the future is tokenized, right? Every financial asset will be tokenized. And it's, not because of some ethos of like blockchain is the future or any kind of ideologically driven, value oriented assessment of decentralization is good. I think it's purely from a utility perspective. Today, you have this financial instrument, but if you can tokenize it, you can do so much more with it. And that has real value. So today, right, you could get credit against it. You could lend it out. You could potentially essentially do what in DeFi you would call like credit looping, right, to try to get leverage on whatever underlying yield your asset has. You could potentially provide liquidity using it. So your asset can do so much more just because it's in this token form. And because it's in this token form, you can really design these DeFi protocols as almost just like vending machines that as long as you are a token, you can be inserted and plugged into. So to me, that is not just coming, that is already happening. And so from a system structuring point of view, I think that's going to displace a lot of existing actors and kind of create the need for new actors as well. And so I think the challenge for everyone, both from the crypto side and from the institutional side, is kind of imagining where along this gradient is that Schelling point, is that merger going to happen. And I think kind of the best strategy here is kind of to burn the candle from both ends, right? And certainly that's what Chronicle is doing with us securing, I think, upwards of $10 billion in DeFi, but also securing just under $6 billion in tokenized assets on the institutional side.
Excellent point. Excellent point. Maybe to bring all this home as we wrap up, can you tell us about in any specific implementation, Oracle, or project that you guys are working on?
Oh, I mean, we're working on so much. We are securing almost all of the tokenized money market funds across various institutional partners. So the likes of BlackRock, Apollo, Superstate, Janus Henderson. There are various private credit products that we support as well. Also from the likes of Apollo and Janus Henderson. We do a lot of stablecoin products. So in particular, M0, which for the listeners, M0 is essentially a stablecoin as a service platform. So anyone who wants to create a stablecoin doesn't have to build up all of the underlying infrastructure themselves. They can just essentially launch a whitelisted stablecoin and benefit from the existing liquidity of all of the other white labeled stablecoins. So very interesting system. And so there, we support more crypto native stablecoins. So, for example, MetaMask USD, we work with Bridge as a US based issuer. Bridge is owned by Stripe. So we have a very kind of interesting hybrid footprint, right, between in the kind of traditional, kind of institutional side, and one foot in the kind of crypto DeFi native side of things.
Amazing. Well, congrats on all your progress. Look forward to continuing to watch you guys grow and succeed.
Absolutely. Thank you so much for having me on, Will. This was great.
Thank you. Niklas Kunkel, thank you very much for joining us today.